Revealed. The US-China Silver War. Nobody is talking about. While the world watches stock markets and debates interest rates, a silent war is being fought. Not with missiles, not with sanctions, but with something far more permanent. China has been executing a strategy for the past 5 years that most analysts completely missed. A strategy that is locking down control of one of the most critical materials for the next half-century. And by the time Western governments realized what was happening, it may have already been too late. The metal is silver. The battleground is Latin America. And what you're about to discover will change how you understand global power itself. Welcome to Morale and Macro. If you have found value in serious economic analysis over the years, the kind that cuts through headlines and shows you what is actually moving beneath the surface, then perhaps you might consider subscribing. No pressure, just a simple click if you believe this kind of strategic insight is worth preserving in your feed. And before we continue, drop a comment below letting us know where in the world you're watching this from. We want to understand how far this information is reaching, because what we are about to reveal is not being discussed in your local financial news. Now, let us show you exactly what is happening. Between 2019 and 2024, while financial analysts debated Federal Reserve policy and investors tracked stock market indices, a transformation was taking place in the global silver market that went almost entirely unnoticed. It was not dramatic. It did not make headlines, and that was precisely the point. China was systematically repositioning itself to control the primary sources of one of the world's most strategically important metals. And they were doing it in a way that bypassed every traditional market mechanism that Western institutions relied upon to track commodity flows. The strategy was elegant in its simplicity. Instead of competing on exchanges like COMEX in New York or the London Bullion Market Association, where prices are transparent and every transaction is visible, Chinese state-backed entities went directly to the source. They traveled to Mexico, to Peru, to Bolivia, to Chile, and to Argentina. They sat down with mining companies, and they signed long-term offtake agreements. These agreements are not complicated financial instruments. They are straightforward contracts. A mining company agrees to sell a specific percentage of its future silver production to a buyer at predetermined terms. The buyer secures guaranteed supply. The mining company secures guaranteed revenue and often upfront capital for operations. On paper, these look like ordinary business transactions. But when examined collectively, a pattern emerges that reveals something far more significant. Latin America produces the majority of the world's mined silver. Mexico alone extracts approximately 200 million ounces annually, making it the single largest silver-producing nation on Earth. Peru follows closely behind. Together, these two countries account for nearly 40% of all silver mined globally each year. These are not diversified sources spread across continents. This is a concentrated geographic region, and China recognized something that most Western strategists apparently did not. Whoever controls access to Latin American silver effectively controls the global supply pipeline. The approach was methodical. Chinese entities did not simply purchase silver on the open market when they needed it. They locked in future production years in advance. They provided capital for mine development. They offered technical expertise. They built relationships with governments and mining executives across the region. And they did all of this while Western buyers continued operating under the assumption that silver would always be available for purchase when needed, that markets would remain open and accessible, that supply chains would function as they always had. That assumption is now being tested. Because when a significant portion of primary silver production is already committed through private offtake agreements before it ever reaches an exchange, the dynamics of the entire market shift. The amount of silver available for spot purchase decreases. Price discovery mechanisms become less reliable. And countries that depend on open market access find themselves competing for a shrinking pool of available metal. This is not speculation. This is documented reality that can be verified through corporate filings, partnership announcements, and investment disclosures that have been public for years. The information was available. It simply was not being synthesized into a coherent strategic picture. Most investors were focused elsewhere. They were watching price charts. They were trading futures contracts. They were analyzing technical patterns and trying to predict the next rally or correction. And while they were doing that, the fundamental structure of the physical silver market was being quietly reorganized. The question that now demands attention is straightforward. What happens when the world's second largest economy secures preferential access to primary supply sources before that supply reaches global markets? What happens when industrial consumers in other countries discover that the silver they assumed would be available for purchase has already been contractually committed elsewhere? What happens when refining capacity, mining output, and logistics networks are increasingly aligned with a single strategic buyer? The answer to those questions is unfolding right now, and it has implications that extend far beyond commodity markets, into technology supply chains, industrial capacity, national security considerations, and the balance of economic power between nations. Because silver is not just a precious metal that investors buy for portfolio diversification, it is an irreplaceable industrial input for technologies that define modern civilization. And someone just secured control of where most of it comes from. Most observers who eventually noticed China's acquisition of Latin American mining agreements made a critical analytical error. They assumed the story ended at the mine. It does not, because owning the rights to extract silver from the ground is only the first step in a much longer process. And China understood something that Western strategists are only now beginning to grasp. The real choke point is not where silver is mined, it is where silver is refined. Raw silver ore extracted from a mine is not the product that industries need. It is not the material that goes into solar panels or electric vehicles or defense systems. What comes out of the ground must be processed, purified, and refined into specific grades before it becomes usable for industrial applications. And refining capacity is not evenly distributed across the globe. In fact, the concentration of refining infrastructure is even more extreme than the concentration of mining operations. A handful of facilities in specific geographic locations process the majority of the world's silver supply. And over the past 6 years, China has been systematically expanding its control over this critical bottleneck. The numbers tell a story that few people have bothered to read. Between 2018 and 2024, Chinese entities invested billions of dollars in refining capacity expansion, not just within China itself, but strategically positioned in the very countries where silver is mined. New refineries were built in Peru. Existing facilities in Mexico received Chinese capital infusions and technology transfers. Joint ventures were established that gave Chinese companies operational influence over processing infrastructure. This created a structural advantage that is extraordinarily difficult to counter. Consider the position of a major silver-producing country like Peru. It extracts hundreds of millions of ounces of silver annually from its mines. But if it lacks sufficient domestic refining capacity to process that ore into finished product, it must export the raw material to facilities elsewhere. And if those facilities are owned, operated, or controlled through offtake agreements by Chinese entities, then Peru has effectively ceded control over its own natural resource. The country mines the silver, but it does not control where it goes or who ultimately receives it. This is not a hypothetical scenario. This is the current reality in multiple Latin American nations. They are resource-rich but infrastructure-poor. They produce enormous quantities of raw silver but depend on external refining capacity to convert it into usable metal, and that dependency creates leverage for whoever controls the processing infrastructure. The same pattern appears in country after country across the region. Bolivia extracts silver, but lacks modern refining facilities at scale. Chile has significant production, but limited processing capacity relative to output. Argentina faces similar constraints. Each of these nations finds itself in a position where the strategic value of its natural resources is captured, not at the point of extraction, but at the point of refinement. And China positioned itself at exactly that point. Now contrast this with the Western position. The United States once maintained substantial silver refining capacity. Facilities operated in multiple states, processing both domestic and imported ore. But over decades, as manufacturing shifted overseas and commodity processing was treated as a low-margin business not worth maintaining domestically, that capacity atrophied. Refineries closed, technical expertise dispersed. Infrastructure was not maintained or modernized. By 2025, the United States refines only a fraction of the silver it consumes. The gap is filled through imports of refined silver from facilities located primarily in Asia and Latin America. Facilities that are increasingly aligned with Chinese strategic interests through ownership stakes, technology partnerships, or long-term supply contracts. Europe faces a similar structural deficit. High-grade refining capacity exists, but is insufficient to meet regional industrial demand. The continent depends on the same global processing network that China has been systematically penetrating. The implications are stark. Refining infrastructure cannot be built quickly. A modern silver refinery requires years of planning. Hundreds of millions in capital investment, specialized technical knowledge, environmental permits, and operational expertise that takes time to develop. It is not something that can be rapidly deployed in response to a sudden supply crisis. This is the dimension that was missed while everyone focused on mine ownership. Because even if Western countries suddenly secured access to new mining operations, even if they signed their own offtake agreements tomorrow, they would still face the fundamental problem of where to process that ore into usable metal. And if the refining infrastructure is controlled or heavily influenced by a competitor, then access to raw material becomes strategically irrelevant. China saw the entire system. They recognized that controlling refining capacity was potentially more valuable than controlling mines, because refineries determine not just where silver goes, but what form it takes, what grades are produced, and which industrial customers receive priority access. And they built the infrastructure while others were still debating market prices. And now that infrastructure is operational, processing Latin American silver with contractual obligations that extend years into the future. The question Western policymakers are now confronting is uncomfortable, but unavoidable. How do you compete for a resource when your competitor controls the infrastructure required to make the resource usable? There's a reason this competition matters in ways that previous commodity disputes did not. Silver is not oil. Where alternatives exist and consumption can be reduced through efficiency improvements, it is not copper, where substitution with aluminum is technically feasible in many applications. It is not even gold, which serves primarily monetary and ornamental functions. Silver occupies a unique position in the periodic table that makes it irreplaceable for specific technological applications that define the modern economy. And the industries that depend on it are not shrinking, they are accelerating. Start with the fundamental physics. Silver possesses the highest electrical conductivity of any element. It has the highest thermal conductivity of any metal. It reflects electromagnetic radiation more effectively than any other material. These are not marketing claims. These are measurable physical properties that cannot be replicated by cheaper alternatives. For certain applications, nothing else works. The solar power industry discovered this reality years ago. Every photovoltaic panel requires silver paste to create the conductive pathways that capture and transmit electricity generated from sunlight. Engineers have spent decades attempting to reduce the amount of silver needed per panel or find viable substitutes. Progress has been minimal. Despite continuous research and significant financial incentive to eliminate an expensive input, modern solar panels still require approximately 20 grams of silver each. Some newer designs require even more, and global solar installation targets for the next decade are staggering. Countries worldwide have committed to massive expansion of renewable energy capacity. China alone plans to install solar capacity that will require hundreds of millions of ounces of silver. Europe has similar ambitions. The United States has legislated incentives for domestic solar manufacturing and deployment. Every single panel requires silver. The mathematics becomes concerning when projected forward. If current solar installation targets are met, the photovoltaic industry alone will consume quantities of silver that approach total annual mining output. And solar is just one sector. Electric vehicle production tells a parallel story. Each EV contains substantially more silver than a traditional internal combustion vehicle. The electrical systems, battery connections, charging infrastructure, and control circuits all require silver for optimal performance. As global automobile manufacturers transition their production lines from traditional vehicles to electric models, silver consumption multiplies. China is already the world's largest EV market. Europe has mandated phase-outs of combustion engines. American manufacturers have announced billions in electric vehicle investments. Every transition plan assumes silver will be available, but no one has publicly answered where that silver will come from when current supply is already committed. The telecommunications sector adds another layer of demand. 5G networks require dramatically more infrastructure than previous generations. Each base station, each connection node, each transmission component contains silver. As networks expand globally and technology advances towards 6G research, the material requirements compound. Then there are applications the general public rarely considers. Military technology depends on silver in ways that have no substitutes. Missile guidance systems use it. Radar equipment requires it. Electronic warfare systems are built with it. Defense contractors cannot simply switch to cheaper alternatives when those alternatives degrade performance in life or death applications. Medical technology relies on silver's unique antimicrobial properties. Advanced manufacturing uses it in specialized industrial processes. The list extends across dozens of sectors. And here's the critical point that investors and policymakers are now confronting. For years, the conversation about silver focused on its role as a monetary metal, as an inflation hedge, as a speculative investment. Those discussions missed the larger transformation happening in the real economy. Silver transitioned from a commodity into a strategic resource. It became strategic the moment that technology is essential for national competitiveness and security became dependent on it. It became strategic when alternatives proved technically or economically non-viable at scale. It became strategic when global industrial plans collectively required more of it than geological extraction could reliably provide. The supply-demand projections are not speculative. They are based on announced manufacturing targets, legislated policy goals, and engineering requirements that are already locked into production plans. Multiple independent analyses have reached the same conclusion using different methodologies. If current technology adoption trends continue, if electric vehicle production scales as planned, if solar installation targets are pursued, if 5G infrastructure is built out globally, the world will face a structural silver deficit within years, not a temporary shortage that corrects through price adjustments. A fundamental supply gap where industrial demand exceeds available supply, regardless of price. This is the context in which China's control of Latin American mining and refining infrastructure must be understood. They are not simply accumulating a precious metal for investment purposes. They are securing guaranteed access to an industrial input that their technology sector cannot function without. And they are doing it while their competitors are still operating under outdated assumptions about commodity availability. The competition for silver is not about speculation. It is about which nations will have the physical materials necessary to build the technologies that determine economic and military power for the next 50 years. And someone just locked up the primary supply chain before most others realized there was a competition happening. The question now is not whether this matters. The question is what happens next when Western industrial consumers attempt to source silver at scale and discover that it has already been contractually committed elsewhere. The realization came late. Too late, some analysts now argue. United States policymakers began recognizing the strategic vulnerability of silver supply chains sometime around 2022, not through proactive intelligence analysis, but through something far more direct. American industrial manufacturers started reporting difficulties securing long-term supply commitments. Solar panel producers could not lock in multi-year silver contracts at predictable prices. Electric vehicle manufacturers discovered that the offtake agreements they assumed would be available were already claimed. Defense contractors flagged concerns about material availability for future production runs. The signals were clear. The supply chain had fundamentally changed. And when government analysts finally examined what had happened, they discovered a structure that had been built over years, while attention was focused elsewhere. Chinese entities had not just purchased silver. They had woven themselves into the production infrastructure of nearly every major silver-producing region outside of North America. The question then became, what could be done about it? The obvious answer would be to expand domestic American silver production. The United States has silver deposits. Mining operations exist. In theory, production could be scaled to reduce dependence on foreign supply chains. But theory confronts reality quickly in the mining sector. Current United States silver production is approximately 40 million ounces annually. Consumption is substantially higher. The deficit is filled through imports. To achieve supply independence would require tripling or quadrupling domestic output. That is not something that happens through policy declarations. New mines require years of permitting before a single ounce is extracted. Environmental reviews, community consultations, infrastructure development, capital raising. The timeline from discovery to production typically spans a decade, and that assumes deposits exist in quantities sufficient to meet demand, which is not guaranteed. Even if every regulatory barrier were removed tomorrow, even if capital flooded into domestic mining operations, the United States could not close its silver supply gap before 2035 at the earliest. China's offtake agreements extend through 2040. The timeline disadvantage is structural, not procedural, so American strategy shifted toward the next available option, securing partnerships with countries that still maintain some independence in their silver supply chains. Nations that have not yet fully committed their output through Chinese agreements. This is where geopolitics becomes complicated. Latin American countries are not passive participants in this competition. They are sovereign nations with their own strategic interests, and they find themselves in an enviable but delicate position. Multiple superpowers competing for access to their natural resources. Mexico has historically maintained close economic ties with the United States, but Chinese investment in Mexican mining operations has grown substantially. The Mexican government must balance its relationship with its northern neighbor against the capital and technology that Chinese partnerships provide. Peru faces similar calculations. Chinese companies operate major mining projects on Peruvian soil. They employ Peruvian workers. They contribute to government revenues through royalties and taxes. But Peru also recognizes the strategic risk of dependence on a single buyer for its primary export commodity. Each country is navigating its own version of this tension, and the United States is attempting to offer competitive alternatives. Development financing through American institutions, technology partnerships, trade agreements that provide market access, security cooperation. But these offers compete against something concrete that China has already delivered: upfront capital, operational expertise, and guaranteed purchase commitments that mining companies can take to banks when seeking project financing. The American response also includes efforts to rebuild domestic refining capacity. Multiple initiatives have been announced. Private companies have proposed new facilities. Government incentives have been structured to encourage investment in processing infrastructure. But again, the timeline is measured in years, not months. A modern refining facility requires enormous capital investment, specialized equipment that must be manufactured to specification, technical expertise that is scarce, and regulatory approvals that cannot be rushed. Even under optimal conditions, bringing new refining capacity online takes 3 to 5 years from groundbreaking to operational production. China built their refining network over the past 6 years, while American capacity was declining. Some policy discussions have turned toward strategic reserves, the idea of government stockpiling of silver similar to petroleum reserves. If supply chains are vulnerable, perhaps buffer stocks could provide time to develop alternatives. The concept faces immediate practical constraints. Building a meaningful strategic silver reserve would require purchasing hundreds of millions of ounces from a market that is already experiencing tightness. The buying pressure itself would drive prices higher and potentially worsen the supply situation it is meant to address. And even if a reserve were established, it would only delay the fundamental problem, not solve it. Industrial consumers need continuous supply for ongoing production, not emergency reserves that are eventually depleted. Trade policy has emerged as another instrument. Tariffs on silver imports from specific countries, export restrictions on American-mined silver, investment screening mechanisms that limit foreign acquisition of domestic mining assets. Each of these tools has limitations and creates secondary consequences that must be carefully managed. The uncomfortable reality that American strategists now confront is that China secured a structural advantage through patient execution of a long-term plan, while the United States was operating under assumptions that no longer reflect how commodity markets function. The competition is not over. Silver will continue to be mined, new deposits will be discovered, market dynamics will shift, but the starting positions are now clearly established. One side controls primary supply sources and refining infrastructure. The other side is attempting to build alternatives, while its industrial base continues consuming silver at rates that exceed available supply. Latin American nations watch this competition with careful attention because their decisions about who receives access to their silver will partially determine which technological superpower maintains industrial capacity over the next several decades. And neither China nor the United States can afford to lose access to this metal given what their economies have already committed to building. The war for silver is not metaphorical. It is a competition for control of physical supply chains that enable technological capabilities which define national power. And it is happening right now, in mining offices in Lima, in refinery facilities outside Mexico City, in trade negotiations in Beijing and Washington, while most of the world remains entirely unaware that the competition exists.